Hey, wealth builders, welcome. Comment the country you're tuning in from. Let's see how global our squad really is. Real estate has always been one of the cornerstones of wealth creation. Historically, it has served as both a store of value and a source of ongoing passive income, making it a favorite asset class for long-term investors. But while it's widely known that real estate can build wealth, few truly understand the full depth of what it entails. To grasp the potential of real estate investing, we must look beyond the basic idea of purchasing property and collecting rent. The real power of real estate lies in leveraging strategic investments, optimizing cash flow, appreciating asset values, tax advantages, and long-term financial security. Let's take a step back and understand why real estate is considered one of the most reliable and secure forms of wealth accumulation, especially when compared to other forms of investment like stocks, bonds, or even cryptocurrencies. For instance, a house or apartment is tangible. It's something you can see, touch, and hold. Real estate has an inherent value because of the need for housing. This is one reason why real estate prices tend to increase over time, as the population grows and land becomes more scarce. More importantly, real estate provides an opportunity for wealth accumulation through multiple avenues, such as appreciation in property value, rental income, tax benefits, and portfolio diversification. Real estate also provides a much-needed hedge against inflation. When inflation rises, so do property prices, because the value of money erodes. This makes real estate a prime vehicle for wealth preservation. Just think about how inflation has affected currencies like the dollar or euro. Their purchasing power declines over time. However, if you own real estate, the physical asset usually appreciates in value over time, keeping pace with or exceeding inflation. For example, in 1985, a median-priced home in the United States cost about $100,000. By 2020, that price had risen over $300,000, marking an annual appreciation rate of around 3 to 4% on average. While there have been cycles of boom and bust, over the long term, real estate has proven to be one of the most reliable assets in terms of price appreciation. This steady growth makes real estate a relatively low-risk investment when compared to more volatile assets. However, not all real estate investments are created equal, and the key to successful real estate investing lies in making informed decisions, utilizing appropriate strategies, and understanding the market dynamics. Understanding real estate cycles, recognizing areas of growth, and managing risk effectively can allow investors to leverage these principles for maximum return. One of the first things an investor should know is the impact of location. The famous saying, location, 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 holds true for real estate because a property's location will determine its long-term value. A house or building situated in a prime location will appreciate much faster than one in a declining or oversupplied area. Consider the example of Silicon Valley, where property prices have increased dramatically over the past few decades due to the booming tech industry. Investors who purchased properties there in the 1990s have seen their investments increase in value exponentially as the tech industry thrived. But location isn't just about proximity to major cities or popular neighborhoods. It's about understanding urban growth patterns, economic trends, and how infrastructure projects like new highways, transportation systems, or commercial developments impact real estate values. For example, in cities where major infrastructure projects are planned, such as the construction of new public transit systems, property values often spike in anticipation of these changes. Understanding these nuances is crucial to making sound investment decisions. As you start looking for opportunities in real estate, it's essential to consider the potential for both immediate returns and long-term wealth creation. Residential real estate, like single-family homes and multifamily units, is the most common entry point for many investors. However, if you're looking to diversify your portfolio and maximize returns, exploring commercial real estate or mixed-use developments could present lucrative opportunities. These properties tend to offer higher rental yields and longer lease terms, making them ideal for investors seeking a steady stream of income. Another strategy for building wealth through real estate is to consider buying undervalued properties. These are properties that may require some work or have been overlooked by the market, but offer significant potential for appreciation and cash flow once renovated. This strategy, often referred to as value investing, involves identifying distressed properties that can be purchased below market value, improved, and then either rented out or sold for a profit. This requires expertise in assessing the true value of a property, understanding renovation costs, and knowing which improvements will offer the highest return on investment. In real estate, this fix and flip strategy can yield substantial profits, but it's also important to note that the execution needs to be precise. Many investors underestimate the cost of renovation or overlook hidden problems in a property. This can lead to cost overruns that erode profits or make the project unprofitable. Therefore, the key to success with this strategy is to have a clear understanding of the costs involved, the potential rental income, and the expected resale value once the property is fixed up. For example, let's say you purchase a distressed single-family home for $200,000 in a growing neighborhood. You invest an additional $50,000 in renovations, targeting both cosmetic improvements, such as updating kitchens and bathrooms, and functional upgrades, like replacing a roof or plumbing. After a few months, the property is worth $300,000, and you sell it for that amount. In this case, you've gained $50,000 in profit after factoring in the purchase and renovation costs. But renovating properties is not without risks. A lot can go wrong during the renovation process, and it requires you to manage contractors, schedules, and unexpected issues. If done poorly, a fix and flip project can turn into a financial disaster. But when done right, this strategy can generate high returns. Now that we've covered the basics, let's dig deeper into more advanced strategies that can take your real estate investment game to the next level. Understanding these strategies is essential for investors who want to scale their portfolio and maximize returns. These approaches may require more capital, a deeper understanding of the market, and sometimes more risk, but the potential rewards can be significant. One advanced strategy involves commercial real estate investment. Commercial real estate is often seen as a higher risk, higher reward asset class compared to residential properties. However, it offers a range of benefits that can make it appealing to experienced investors. These benefits include the potential for higher rental yields, longer lease terms, and more diverse tenant bases. For example, office buildings, retail centers, and industrial properties tend to generate more consistent and predictable cash flows than residential properties, especially if you secure tenants on long-term leases. Investing in commercial real estate requires a thorough understanding of the market dynamics in the area where you're buying. It's important to understand the demand for commercial properties, the type of businesses that are thriving in that market, and the trends in rent prices. For instance, the demand for office spaces has shifted dramatically in recent years due to the rise of remote work. Commercial real estate investors must be aware of these trends and invest in properties that have long-term potential. Consider the example of e-commerce. The explosion of online shopping has created a surge in demand for warehouse spaces and distribution centers. As e-commerce companies grow, they need more industrial spaces to store and ship products. This is a key opportunity for investors to consider when looking for high-demand commercial properties. However, even within commercial real estate, different sectors have different risks and rewards. Investing in retail spaces, for instance, can be riskier if there's a downturn in consumer spending or if retail businesses go bankrupt. The key is to balance your portfolio and choose the right properties that align with your risk tolerance and investment objectives. Another strategy that can significantly increase your wealth is multifamily housing investments. Multifamily units like apartment buildings, duplexes, and triplexes offer several advantages over single-family homes. One of the biggest advantages is that they provide economies of scale. Instead of managing several single-family homes, you're managing one multifamily property, which reduces maintenance costs and increases efficiency. Furthermore, multifamily properties tend to generate higher rental yields than single-family homes, as they often have multiple units that are rented out simultaneously. The risk of vacancies is also reduced, as the loss of one tenant doesn't necessarily mean the loss of all income from property. Multifamily properties are ideal for cash flow investments. For example, if you purchase a 10-unit apartment building for $1 million and each unit rents for $1,500 per month, your total monthly income would be $15,000. If your expenses, including mortgage, property taxes, and maintenance, total $10,000, you'll generate a $5,000 positive cash flow each month, or $60,000 per year. This steady cash flow can provide financial stability and allow you to scale your portfolio more quickly. Another key strategy in real estate is real estate syndication. A syndication is a way for multiple investors to pool their resources and invest in larger properties that they wouldn't be able to afford individually. By pooling funds, investors can gain access to larger, more profitable properties, such as office buildings, apartment complexes, or even commercial shopping centers. Syndication offers a way to diversify your real estate investments without having to manage the properties yourself. For example, in a typical real estate syndication, one investor might provide the capital for a project, while another provides a property management expertise. As a result, everyone involved shares the risks and rewards of the investment. The syndicator or managing partner usually takes a fee for their services, but also shares in the profits. This structure allows investors to participate in larger projects without the responsibility of managing them on a day-to-day basis. Real estate investing, as we've already discussed, is one of the most effective ways to build long-term wealth. However, what truly separates successful investors from those who fail is psychology. This might surprise you, but your mindset and emotional management are as important as the strategies you implement, whether you're a first-time investor or a seasoned one. Mastering the psychology of investing will determine how well you weather the ups and downs of the real estate market. Overcoming fear, the first hurdle. One of the first emotional challenges every investor faces is fear. Fear of making the wrong investment, fear of losing money, or fear of the unknown. Real estate can be a complex and intimidating field for many people, especially beginners. It's natural to feel a sense of uncertainty when investing large amounts of capital, particularly in something as substantial as real estate. Take Sarah, for instance. A 30-year-old professional with a stable job and steady income, Sarah had always dreamed of buying her first property. However, despite her dreams, she was paralyzed by fear. She constantly asked herself, what if the property doesn't appreciate? What if the rent doesn't cover the mortgage? What if I lose everything? These thoughts kept her from taking the first step. Fear is one of the most powerful emotions in investing and often stops people from acting. Sarah's story is a common one. Fear of failure can be debilitating, but here's the thing. Failure is part of the learning process. Every investor, even the most successful ones, faces setbacks and challenges. What separates the successful from the unsuccessful is not the absence of fear, but the ability to move forward despite it. The key to overcoming fear is education. When you're informed about the market, the process, and the risks, fear no longer has the power to control your decisions. Researching the real estate market, understanding property values, and learning about the local economy can help you feel more confident in your decision-making. Once you understand the risks and rewards of real estate investing, you'll be able to manage your fear and take calculated steps toward success. The dangers of impulsive decisions. FOMO. Another psychological trap that investors frequently fall into is FOMO, fear of missing out. When property prices start rising, it's easy to feel like you need to jump into the market quickly or risk missing the opportunity altogether. This emotional reaction can cloud your judgment and lead to impulsive decisions, often with disastrous results. Many investors, driven by FOMO, end up purchasing properties that are overpriced or not aligned with their financial goals, simply because they fear missing out on potential gains. For example, take the case of Jack. Jack was a first-time investor, and when he saw his friends making significant profits from real estate, he became eager to join in. His friends had purchased properties in rapidly gentrifying areas, and Jack didn't want to miss out. He rushed to buy a property in the same area without fully evaluating the potential return on investment. Within a few months, the market slowed down, and Jack found himself stuck with a property that wasn't generating the income he had anticipated. He failed to realize that buying a property based on hype and emotional pressure is never a sound strategy. The lesson here is that investing should never be driven by emotion. You need to separate your emotional impulses from your investment strategy. Make decisions based on data, research, and long-term goals, not on what other people are doing or how quickly the market is moving. Successful investors are patient and strategic, and they understand that great opportunities will come and go. If you miss one, another will follow, and it's better to wait for the right opportunity than to rush in based on fear or peer pressure. The role of self-doubt, learning to trust yourself. As an investor, especially if you're just starting out, it's natural to experience self-doubt. You might constantly question whether you're making the right decision, whether the market will shift, or whether your investment will actually pay off. Procrastination or second-guessing, both of which can paralyze your progress and prevent you from taking action. Let's take David, a mid-career professional who had saved up enough money to purchase his first rental property. However, every time David considered making an offer on a property, he doubted himself. What if the market was going to crash? What if the neighborhood wasn't as good as he thought? What if tenants didn't pay rent? These worries kept him from pulling the trigger. David's hesitation is common among new investors, and it stems from lack of experience and fear of failure. But here's the thing, action is the antidote to self-doubt. The best way to combat self-doubt is to start small and build experience. Begin by investing in a property that's within your comfort zone. This could be a smaller, less risky project like a single-family home or a duplex. By taking that first step, you'll gain valuable experience and confidence, which will allow you to make bigger, more informed decisions as you progress. Self-doubt is natural, but it should never prevent you from taking action. The more you learn, the more confident you'll become. Start by making informed decisions. Surround yourself with trusted experts and take calculated risks. Over time, your self-doubt will fade as your experience grows. The role of greed, the temptation to over-leverage. While fear and self-doubt can hold you back, another psychological challenge investors face is greed. When prices are rising, it can be tempting to chase after higher returns by buying more properties, taking on more debt, or increasing the size of your investments. The desire to maximize profits quickly can lead investors to make risky moves, like over-leveraging their assets or buying properties that aren't aligned with their long-term goals. Let's consider Emily, a successful real estate investor who had built a small portfolio of rental properties over the years. However, as her portfolio grew, Emily became increasingly focused on expanding quickly, started using high levels of leverage to finance her acquisitions, and in doing so, took on more debt than she could comfortably manage. When the market took a downturn, Emily found herself struggling to make mortgage payments, and her properties lost value. This story illustrates how greed can cloud judgment. It's easy to become overconfident when things are going well, but greed can blind you to the risks involved in real estate investing. The lesson here is that moderation is key. Avoid the temptation to over-leverage and always ensure that your investments align with your long-term goals. Stay disciplined, make calculated decisions, and avoid chasing after quick profits at the expense of sound financial management. Developing emotional discipline. At the core of successful real estate investing is emotional discipline. Whether it's managing fear, greed, or self-doubt, the most successful investors are those who can control their emotions and stick to a strategy. Emotional discipline allows you to make decisions based on logic, not on impulsive reactions to market conditions or personal anxieties. Here are some tips for developing emotional discipline in real estate investing. Set clear investment goals. Knowing exactly what you want to achieve with your real estate investments will help you stay focused and avoid making decisions based on fleeting emotions. Stick to your strategy. Don't deviate from your plan when things get tough. Successful investors know that real estate is a long-term game. They stay patient and stick to their strategy, even in times of uncertainty. Educate yourself. Knowledge is one of the best ways to combat fear and self-doubt. The more you understand about the market, the more confident you'll feel in making informed decisions. Surround yourself with experts. Build a team of trusted professionals, real estate agents, property managers, contractors, and financial advisors. They can provide valuable guidance and help you navigate the emotional challenges that come with investing. Embrace failure as a learning opportunity. Every mistake is an opportunity to learn. Don't be afraid to make mistakes, as they are an inevitable part of the investing journey. What matters is how you bounce back and apply the lessons learned. As we come to the end of this comprehensive guide on real estate investment, it's important to reflect on everything we've learned. Real estate investing is not just about finding the right property. It's about creating a holistic strategy that aligns with your financial goals, personal values, and risk tolerance. By combining strategic planning, smart market analysis, and emotional discipline, You can build a robust and sustainable real estate portfolio that generates passive income for years to come. Building a long-term investment strategy. The most important thing to remember in real estate investing is that it's a long-term commitment. While it's tempting to chase after quick returns, the true wealth-building potential of real estate lies in its ability to appreciate over time and provide steady cash flow. Therefore, your investment strategy should always have a long-term outlook. You're not just investing in properties. You're investing in your future financial security. Consider the example of Robert and Lisa, a couple who started investing in real estate when they were in their early 30s. They purchased their first property, a modest duplex, and rented out both units. Over the years, they used the rental income to pay down the mortgage, reinvested their profits into additional properties, and strategically diversified their portfolio. Now, in their late 40s, they own a diverse portfolio of multifamily properties and have substantial passive income from rent. They didn't get rich overnight, but by staying disciplined and patient, they built a long-term wealth strategy that will continue to grow for decades. Real estate investing requires time, effort, and a lot of learning along the way, but the rewards are worth it. When done correctly, it's one of the most reliable ways to accumulate wealth. The key is to stay disciplined and focus on your long-term goals, even when the market experiences short-term fluctuations or downturns. Stay informed and adaptable. Markets change, and as an investor, you need to stay informed and adaptable. Real estate markets are cyclical, and there will be times of booms and busts. Successful investors understand that they must be prepared for both. During a boom, they know when to sell or capitalize on equity gains. During a downturn, they know when to hold or find opportunities to buy at discounted prices. The key is to remain adaptable and not to panic in times of market volatility. In addition to staying informed about the local real estate market, it's also crucial to monitor economic trends that can impact real estate. For example, changes in interest rates, tax laws, or urban development plans can significantly affect property values. By staying ahead of these trends, you can position yourself to take advantage of upcoming opportunities. The importance of building relationships. Real estate is not a solo sport. It requires collaboration and building relationships with professionals in the industry. Whether it's real estate agents, property managers, contractors, or financial advisors, your network will play a vital role in your success. Surround yourself with a team of experts who can provide advice, guidance, and support. The most successful investors have a team of trusted professionals who help them navigate the complexities of the real estate market. It's essential to build relationships with these people over time and make them part of your investment process. With their help, you can avoid common mistakes, make more informed decisions, and scale your portfolio more effectively. Final words: your path to financial freedom. At the end of the day, real estate investing is about building wealth and achieving financial freedom. But it's also about taking control of your financial future and making smart decisions that align with your personal goals. As you move forward, remember that success in real estate comes from strategic planning, patience, and discipline. Start small, stay educated, and always focus on your long-term goals. Over time, you'll build a diversified real estate portfolio that will generate passive income, appreciate in value, and provide financial security for years to come. Thank you for watching. And I hope this comprehensive guide has given you the tools and mindset you need to take action and start investing in real estate today.